Just a quick heads up before we get rolling. The information in today's explainer is just for educational and informational purposes, right? It's not financial advice, investment recommendations, or an offer to buy or sell any securities. Valero Energy Corporation is a publicly traded company, and obviously all investments carry risk. Past performance doesn't guarantee future results, so definitely consult with a qualified financial pro before making any moves. Oh, and all the data we're talking about is sourced from publicly available info as of August 2026. All right, with all the legal stuff out of the way, welcome. Today, we're digging into the ultimate paradox unfolding in the energy sector right now with Valero Energy Corporation. We're looking at a company that is seemingly doing everything perfectly, but somehow they're sitting right on the edge of a massive unknown. Okay, let's dive into this because this single number tells an absolutely wild story. As of late August 2026, Valero's stock is trading at roughly $348 per share. But get this, just 12 months ago, it was scraping the bottom at a 52-week low of $145. That is a jaw-dropping gain of nearly 140% in just 1 year. I mean, if you had this in your portfolio, you'd be absolutely thrilled. But it also begs a massive question, and it's created a really fascinating conflict. Investors are actively asking, is this incredible run a story of sustainable long-term value creation, or is the market currently pricing in absolute perfection at the absolute peak of a historic cycle?
Here is our roadmap for today. First, Q2 earnings. Second, global supply and demand. Third, the renewable diesel wildcard. Fourth, Wall Street is divided. And fifth, the final verdict.
Number 1. Record-breaking Q2 earnings. Let's start with the hard numbers that really kick this entire conversation into high gear. Valero's second quarter earnings from July 30, 2026. These results completely stunned the financial world. Think back to Q2 of 2025. Valero brought in $714 million in net income, which worked out to $2.28 per share. Fast forward exactly 1 year to Q2 2026. Net income absolutely skyrocketed to $3.7 billion. That is $12.62 per share. Their adjusted earnings came in at $12.54 per share, which didn't just beat the consensus estimate, it shattered it by 27%. To really put that into perspective, you have to remember that massive, mature oil and gas companies usually move like heavy cargo ships, right? They're steady, they're predictable. So for a massive company of this scale to beat estimates by 27%, that is incredibly rare and points to just immense operational efficiency. And the revenue? A staggering $44.48 billion, up nearly 49% year over year. As CEO Lane Riggs put it, this was a quarter of exceptional operational and commercial performance.
So when you break down that performance by segment, the powerhouse is crystal clear. Refining is the absolute dominant force here, generating $4.5 billion in operating income. That's up from just $1.3 billion a year earlier. Total refining margins hit $6.34 billion. And here's the metric you really want to pay attention to. The margin per barrel jumped from $12.35 all the way to $23.62, and they pulled this off while maintaining a massive throughput of about 3 million barrels per day. For some context on that sheer volume, 3 million barrels is roughly 126 million gallons of liquid passing through their pipes every single day. That's like filling up almost 200 Olympic swimming pools daily. The other segments are holding their own too, by the way. Ethanol posted $318 million in operating income, and renewable diesel brought in $717 million, which we're actually going to look at much closer in just a minute.
All of this operational success leads to an incredible cash position. Valero ended the quarter sitting on a massive $7.87 billion cash stockpile, well above their long-term target. And because they're so flush with cash, they returned $2.6 billion to shareholders in Q2 alone and just announced a brand new mammoth $5 billion share buyback program. For anyone holding the stock, this is exactly what you want to see. The company is using its mountain of cash to shrink the total pool of available shares. Think of the company like a pizza. By reducing the total number of slices out there, the slice you hold theoretically becomes that much more valuable.
Number 2. Global supply and demand. So, the obvious question is, why is this massive surge happening right now? To really understand Valero's phenomenal run, we have to look outside the company. We need to look at the macroeconomic drivers shaping the entire global market. The reality is global refining capacity is severely constrained right now. According to the International Energy Agency, global refinery crude throughput is running about 5 million barrels per day below where it was just last year. And the causes are entirely geopolitical. The global energy grid is deeply interconnected, so a disruption half a world away directly impacts the bottom line of a refinery in Texas. We've got the US-Iran conflict disrupting crude flows through the Strait of Hormuz. We've seen direct attacks on critical refineries in both Saudi Arabia and Russia, which yanks vital supplies straight off the grid. And on top of all that, following drone strikes that shut down multiple domestic facilities, Russia actually implemented a ban on international diesel sales through January 2027. In fact, Russian seaborne oil product exports fell by over 54% year-over-year in July alone.
And this brilliantly illustrates the concept of a crack spread. You hear this industry jargon all the time, but it's actually super simple. Think of it like a bakery. The crude oil is the cheap raw flour, and the refined diesel is the expensive, fancy artisan bread. The crack spread is literally just the profit the baker makes for doing the hard work of turning one into the other. When global supply gets choked off by all these geopolitical events, the world gets desperate for that artisan bread, so the value of those refined products shoots way up relative to the raw crude flour.
Which brings us to this record-shattering number. In mid-August, the U.S. diesel crack spread hit an all-time high of $102.20 per barrel. At the exact same time, U.S. distillate inventories, which includes diesel, plummeted to their lowest levels for that time of year since 1996. So, with 14 refineries running full tilt, Valero is perfectly positioned to capture this unprecedented margin. And because of these really unique global shortages, Valero is basically playing geographic matchmaker. It's an open arbitrage opportunity. They're exporting gasoline to Latin America and jet fuel to Europe, capturing massive premiums wherever the desperation for fuel is the highest.
Number 3. The Renewable Diesel Wildcard.
But it's not just traditional refining padding Valero's pockets right now. Their Diamond Green Diesel joint venture is arguably the most surprising and honestly the most compelling part of their recent quarter. In Q2 of 2025, the renewable diesel segment actually posted a $79 million loss. Fast forward just 1 year later, it swung to a massive $717 million profit. I mean, that is a staggering turnaround. Valero's margin per gallon in this segment rose from just 22 cents to $2.52, pushing out 3.8 million gallons of sales volume every single day.
So, the crucial point is understanding the mechanics behind how this turnaround happened. It basically comes down to two things: D4 renewable credit values and feedstock costs. Let's break that down real quick. Feedstocks are just the raw materials used to make renewable diesel. We're talking things like used cooking oil from restaurants or animal fats. D4 credits are essentially government incentives given to companies that produce this renewable fuel. Recently, the value of those government incentives has skyrocketed, increasing way faster than the cost of the cooking grease and fats needed to make the fuel. And Valero's management expects these highly profitable incentive values to remain safely above the cost of the raw materials all the way through 2026 and 2027. But there's actually a bigger structural story at play here. Valero anticipates the existing credit bank could actually be completely depleted between late 2026 and mid-2027. Why? Because the broader industry's renewable diesel production is falling short of federal compliance obligations. When you combine that looming shortage with the new Section 45Z Clean Fuel Production Credit, which heavily favors domestically produced fuels, it creates some incredibly durable momentum. Basically, in plain English, government policies are creating a massive, highly profitable moat for domestic producers like Valero. And that advantage isn't going away anytime soon. It keeps credit values elevated and significantly boosts demand for domestic agricultural feedstocks, like soybean oil.
Number 4, Wall Street is divided.
This builds perfectly into the core paradox of our explainer. We've got a company with record profits, an incredible cash stockpile, a war-constrained global supply chain, and this highly profitable green energy wildcard. So why are financial experts suddenly acting so skeptical? When you look at Wall Street right now, it is literally a heavyweight boxing match. On the bull side, the momentum looks completely unstoppable. Valero is named Zacks' Bull of the Day with a strong buy ranking. Goldman Sachs maintains a buy rating with a $365 target, TD Cowen raised their target to $350, and JP Morgan holds at $339. After 7 consecutive earnings beats, the bulls are saying Valero is absolutely printing money. But then you have to look at the bear case. Erste Group Bank recently downgraded Valero from a buy to a hold, and their reasoning is incredibly pointed. They explicitly stated that U.S. refining margins actually peaked back in mid-July and have been falling significantly ever since. They expect this weakness to continue, bringing gravity back to the situation.
The bears are pointing straight at the future outlook. While 2026 is projecting a massive $36.95 per share in earnings, look what happens next year. For 2027, the consensus estimate drops to $26.70. That implies a staggering 27.7% year-over-year decline in earnings.
The historic party, according to the math anyway, is setting up to wind down.
Which leads us to this rather shocking fact. 19 out of 20 analysts polled currently have price targets below Valero's current trading price of around $348. The average forecast among those analysts actually implies an 8.7% downside from current levels. Furthermore, Valero is trading at a trailing EV to EBITDA multiple of 7.1x. In finance terms, an EV to EBITDA multiple basically tells us how expensive a stock is compared to the actual cash it generates. At 7.1x, Valero is trading noticeably higher than its peers in the integrated oil and gas industry. Basically, they are priced for absolute perfection, right when the market is expecting a potential downturn.
Number 5, the final verdict.
Weighing these incredible, record-breaking rewards against the looming risks, we come to a really critical synthesis. Look, Valero is undeniably a world-class operator. They have immense scale, brilliant export flexibility, and those really durable renewable diesel tailwinds supporting them for years to come. And management rightly points out that global inventories could remain tight all the way through 2027. But we have to remember that energy markets are notoriously volatile. Commodities are deeply cyclical. Timing is absolutely everything here. And right now, Valero is trading at a premium price that leaves absolutely zero room for error if those global margins actually do begin to compress and normalize.
So is the Valero paradox a story of an operational powerhouse successfully transitioning into a highly profitable green energy future? Or is it just a classic commodity peak waiting for gravity to take over? Keep this question at the front of your mind as you watch the energy sector over these coming months. Thanks so much for joining me for this explainer, and I'll catch you next time.